Hit it.
It's Friday, November 14th, 2025, episode 278. I'm Patrick Ceresna.
And I'm Kevin Muir. This week, it's a no-guest show, so for those who tune in solely to hear what smarter folks think, we'll see you next week. For everyone else, stay tuned for Patrick's Talking Charts, where he answers the question on everyone's mind: is this the start of a bigger decline in the U.S. stock market?
Yeah. Well, listen, normally I invite Danny on here to introduce the beer. We gave him the week off right now, but so I'm going to introduce my own beer. So I'm going to drink the Flying Monkeys Paranormal Imperial Pumpkin Ale. So we're doing a pumpkin ale in the spirit of the fall. It was just after Halloween here, so we're gonna give this a go and see how this tastes. In the interim, why don't you or why don't you just go on with the disclaimer here, buddy?
All right. Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in this show. Side effects of too much huddle may include having to drink pumpkin beer, rate hike residue disorder, the tech titan tension tremor, and then finally, this is something that I am suffering from: the Nvidia earnings euphoria disorder, otherwise known as the need.
There you go. Well, listen, this is an awful beer. Just a disclaimer to everyone. This is gonna get a bad rating. Okay, all right, buddy. So let's get to the charts.
So, Patrick, there's lots going on. We're kind of at a crucial point in the markets. I'd love to hear what you're thinking here.
Listen, things are getting spicy.
Yes,
there's no other way to put this. We had on the S&P now 4 attempts to break below the 50-day moving average. Each time, including today in the middle of the morning, like let's call this the afternoon session, start of the afternoon session almost, the market breaks below the 50-day, and the bulls come in, save it, and take it off the edge of the cliff. Why this 50-day moving average? It's not like a 50-day moving average is this magical, technical holy grail, but it is actually a very good depictor of trend. Like if you observe the S&P and almost all the stocks, like the Mag 7s that got above their 50-day moving averages, have more or less in the last 6+ months stayed above there without violating them once. So it's a very good way of just having a rule of thumb of, is a stock trending at a one point. But the relevance of this 50-day moving average right now is that a lot of the systematic CTA triggers just so happen to at this moment be lining up with a lot of the levels just below this 50-day. And so we're in a situation where when we look at things from a bearish perspective, there's 2 kind of ways to break it down. There are those people that are bearish on the AI bubble, and there's those people that are trying to, in the big picture, ask, is this the major turning point of the AI story? We'll talk about Nvidia in a moment on the markets, and that in itself could lead to because the weighting of these Mag 7s and other major semiconductors are so big, it's going to be very hard for the S&P 500 on a market cap basis to make any progress if there's a correction going on in these stocks. So there's that one theme, but there's a second theme, which is just the reality of flows. And when a market rallies this far, a part of that rally was many CTAs, vol targeting funds, and gamma dealer positioning stuff, VANA flows. All these things were tailwinds for the market that actually allowed there to be a natural bull trend to be occurring. And we're just from a quantitative and technical perspective looking at where can those flows pivot? Where can those people that were buying all along systematically, without discretion, without emotion, be forced to hit the bid and create that air pocket that can create a much deeper and clearer kind of breakdown in the markets? And so I want to separate the two, because as far as I'm concerned, we've been long overdue for this kind of 5+% market correction, going back to the start of the decade, back to 2020, there have been over 20 market corrections of 5% or greater. And on average, they have occurred 3 to 4 times a year. So the fact that we have basically since April, going over 6 months, gone without a 5% correction has made this the 100th percentile of not only the longest period without a 5% correction this decade, but it's also the steepest rally we've had this decade without a 5% correction. And so some sort of mean reverting correction is overdue. And when some sort of trigger is hit, and whatever the catalyst drives that trigger, the stock market's going to go through a correction. It's what it does all the time. And so let's first look at this purely from that correction perspective, and then we could talk AI afterwards and the potential turning points. So if we have a legitimate close below the 50-day, and more importantly, the first period from which the market breaks to lower lows, it is very likely that the sellers will hit that bid pretty hard, and we could have some sort of a deeper, more meaningful market correction. To me, the target zones when those triggers are hit, and the thing is, the debate is the trigger imminent? I still believe the trigger is much more likely going to be post Nvidia's earnings, and maybe even post OPEX. Next week on Friday, we have the big option expiration. We could hold in for 3, 4, 5 more trading sessions before the vulnerabilities there. But I don't think there has been a more vulnerable moment in the market than actually right now.
Yeah.
And we're before, even let's say 2 weeks ago, we were 200 to 300 S&P points above trigger points, which is the market at any point could have dropped 200 points and the bulls could easily still save it because it didn't create the feedback mechanism of selling. But with us now trading down to this trigger, not only did we hit it back on that Friday sell-off, but again, here we are another Friday, and once again, coming right down to that level, we're at a situation where the triggers are persistently rising and the market is no longer rising. And so the triggers are becoming closer and closer to where the price is, making it the best analogy to give is that the market is persistently stepping closer and closer to an edge of a cliff, and we're just waiting to see whether it loses its footing and actually begin some sort of a sell-off. And so for me, this is a highly fragile moment in the market. Doesn't make it imminent to the day, but I would be shocked if the market wasn't already selling this month. At some point right now, in this post-November expiration, post-Nvidia earnings, I feel there's a very good odds that we're in some sort of correction. If we got a correction, there are a couple key levels to watch. The 38% retracement of the entire rally that we had. So when we take this entire rally, the 38% retracement lies around 6,200, which conveniently lies at where previous highs act like support. So previous resistance is now support. It's a technical rule that exists, and it's a key Fibonacci zone. So if for whatever reason the triggers got kicked in, a very fast and rapid drop towards 6,200 on the S&P would be the first major target point for a market drop. And now, if that sustains below the 50-day moving average on a sustained basis, there could be another leg that sees us temporarily trade below 6,000, maybe 5,800 or so on the downside if we got that kind of selling. Because I think we talked about on the show, I don't remember who was the one that maybe you could reference a name who was the one talking about it, but the first leg of a market drop is almost always very well hedged up. There's a lot of people that hedge up on these first drops, but then they cover their hedges and the market stays very vulnerable, and even people attempt to buy it. So when the next leg comes around, it can always be steeper and more violent, because traders were not positioned for it. Much higher volatility premiums make it less attractive to hedge. All these different plays come in. And so if I was to give a sequence, just from a logical perspective, we have a quick drop towards 6,200 when it plays out. And if it ends up being a failed rally and a period, we could see a Christmas massacre scenario where we, well, it's a good, we're going to be going to Christmas season when everyone's going to be wishing Santa's rally shows up, but we could have a quick drop below 6,000 on a correction there. And that would put this correction in that 15+% kind of zone if we got this leg. And that would be all I would be looking for the first leg. Now, the second question would then be, if we got this kind of a correction, is it marking a correction just in the fact that the market was unstable, the breadth of the market's deteriorating, all these different things. We just needed a reset of the risk reward proposition. And that once that correction happens, the bull market resumes? Or is it going to be signifying the actual peak and bursting of the AI bubble? Because I don't have the answer to that, by the way. This is something we would discover only after the fact. But if it is the bursting of the AI bubble, then we'd have to entertain a question: does a correction in the market, is it actually the first leg of a bear market? Or is there something that's going to happen, in 2026 that this kind of a sell-off triggered? The best analog to that is the way the market here, I'll put on a weekly chart, the way that the market kind of played out in 2007, where basically there was the first leg of a market correction on the downside that happened in that November, December, January period. And then when everyone realized that something was systemically wrong in the financial system, it became a bear market. And that bear market really arguably started in April of 2008, when things really rolled over and things started to deteriorate and that negative feedback loop happened. And so I think it's incredibly premature to speculate on the bear market side, because a lot of things actually still have to happen. I'm at this moment open to the idea that this could just be a correction that is a buy on dip, and the market could still go higher. But the probability we get a correction here, I think, is very, very high. And the market has probably not been more vulnerable to the start of this correction at any point than now. And this is something to watch here. Do you have any comments to make, or you want me to just go on?
No. So I first of all, I've never heard someone explain this idea of the stock market going sideways and the trigger becoming closer and closer to it. And I thought that was really smart and really well articulated. So kudos for that. It really kind of crystallized in my mind why you believe we're much more vulnerable than we've ever been.
A great example, quickly, I'll let you continue, but I want to show you is that this period before Liberation Day correction was this 3-4 month period where exactly that same scenario happened. The stock market stopped going up and the triggers kept going higher and higher, for it, allowing just one quick breakdown to suddenly trigger the chain reaction of systematic selling that basically, and rises in realized volatility that triggered that huge dislocation in the positions of all of the systematic traders. And the longer we stay sideways here, the more vulnerable the market becomes to just one small, a little drop in the market being all it took to actually create the chain reaction. And that is definitely a vulnerability here.
Right. The other thing I would just kind of highlight is that, you and I have been bearish for a little while, or at least I shouldn't speak for you, but I've been bearish for the past month or so. And I've been getting lots of flack and people, making fun of me, calling me a grumpy old man.
That's actually a good sign, by the way.
Yeah. But I would kind of say like one of the things that I always love to reference is that Bruce Kovner line where he says, "What I'm really looking for is a market that is not confirming consensus." And to me, the consensus was that we're going to rally into year end. Everyone's
Yeah.
bullish, yada, yada, yada. But the reality is, when you look at the stock market, it hasn't been that strong. And
No.
it's been, as you've highlighted, it's been increasingly more and more narrow. It's rallied on the back of just a few stocks, and that the rest of the market is doing badly. And even the indices haven't been like, it's not like you're up huge amounts over the last month. It's kind of almost a wash in terms
Right.
of where we are now. So it seems to me there's lots of people that are bullish, and there's lots of folks that are selling, because the reality is the stock market's not going up.
So what are the things that the kind of canaries in the coal mine that are slowly dying, that are warning that something is ahead of us? One of the things for me is the continued deterioration of market breadth. And if you go back, so right now we're at 44%, which is, and just a
44% of
week
what?
ago,
Tell people what did
I'll explain in a second, but
Okay.
but we were at 35% just a week and a half ago. Now, what this is how many stocks of the S&P 500, the 500 stocks, how many of them are above their 50-day moving averages? So, like at the beginning when we talked about the 50-day moving average being a depictor of trend, at the after the April rally, we were at 85% of stocks above their 50-day moving averages. That bounce off of the Liberation Day low basically had huge participation. The entire stock market rose in this beautiful kind of rebound rally. Breadth became super strong. We've now seen basically since July, we're talking 4 months of systematically lower lows and lower highs, deterioration as fewer and fewer stocks continue to participate in this market. Now, this is not that important to the S&P. Why? Because the market cap weighting of the Mag 7s was like 36%. That was the last time I heard the number. I don't know what it is today, but they're basically 1/3 of the entire S&P 500 in a basket of 7 stocks. And we're in a situation where, well, as go the Mag 7s, really will go the S&P, but the underpinning market was really deteriorating. Now, so this deterioration of breadth, it is, to me, is a huge warning. As an example, you could see the breadth really deteriorated before the little December correction before Liberation Day, and then and during the rally going into January and early February, you basically never had breadth return back above 55%. And then during Liberation Day, we basically go almost to zero, where almost every single stock in the stock market was in a downtrend. Right, like it wasn't zero, but very close to on that. But the point is, the breadth was deteriorating persistently from the August-September highs. So when breadth deteriorates, it is not healthy for the market. Right, you want a bull market needs good, healthy, broad participation, to kind of like the tide rising and all boats rising in the tide. Well, that's not there. So this has been based on Mag 7. And when we look at the Mag 7, well, there's a problem all of a sudden, right? Like, first of all, the Mag 7 rock and rolled, right? Like you had the Mag 7 basically from trough to peak have a 77% rally that basically drove this entire S&P move and made the NASDAQ up 50% off that same period from trough to peak. And so the Mag 7s have this epic rally, but this is the first negative price action. Now, while we broke below the 50-day moving average for the first time this morning, we're looking to close back above it. It's like it was at the edge of the cliff and they made the big save here. But this is the first time that we have seen a sell-off wipe out the entire previous rally. Almost every prior period, their sell-offs would be very short and shallow, immediately bought on dip, and off to a fresh new 52-week high and punching new levels, right? Like the market was systematically doing that. The fact that we wiped out the entire previous rally immediately increases the likelihood that we're witnessing a topping formation constructing itself on the mag 7s. And so when we have the breadth of the market deteriorating, and the only thing that could keep this market going starting to show some warning signs, you can see that this is not adding up to being good. Like what the hell is going to save this market if it's not going to have breadth or the mag 7s?
Yep.
And so this is where we're at with a little bit of a structural problem with the market. Now, to me, the beta 1 asset out there are the financials, the XLF. And the XLF, the financials, they have traditionally always participated with the S&P, almost beta 1, right? Like they diverge a little bit, but generally they correct with the market and they rally with the market. They generally are a tell. You can see that overall we have not made any real progress since July on the financials doing anything. They have been generally topping, and some technicians would love to jam a cookie cutter shape of a head and shoulders pattern on the financials here, including what now was a very clear rally into what would be a right shoulder of a topping. So one of the canaries that's about to die is if the financials crack below 52. If we see a breakdown, now have the financials broken? No. Are they still within the trade range? Is there some sort of sell-off? No. But with them not participating for 4 months, if we see the financials start to sell, this is a problem. And I would consider a warning. Now, another thing that I always consider a warning is how are the junk bond markets trading? Very relevant, considering that there's been a lot of stories pushing back on all of the AI credit that's been created, and the problems of the downgrades, like in Oracle's debt ratings and all these different things that are happening under the surface of this. The question is, when do junk bonds start to actually show that their liquidity in that market has dried up? And again, you had a clear double top formation form up along the high. And at the same time, we now have had a rally off the neckline that failed at the 50-day moving average and fib zone, trading right to the neckline almost the same time as the financials index is doing it, the same kind of thing. And so is the canary dead on these yet? No. But what this one wise guy I do this show with on the Market Huddle it made an observation that that there. Tell me if I'm paraphrasing it correctly, but there have been a lot of 5% market corrections where junk bonds are inactive or not participating, but almost every 10+% market correction has usually a breakdown in a high yield junk bonds on the downside.
Yeah.
And so if we have a breakdown in these high yield here, then that scenario I drew out to 6,200 and potentially even 5,800 on the S&P, which would be that 15 to 18% kind of market correction, becomes a reality that's on the table. And so you can see, have we triggered on financials? No. Have we triggered on high yield? No. But everything is at the edge of the cliff.
Yep.
And all it needs is a little push. And if what will that be? Is it going to be Nvidia's earnings? It's the most obvious thing that could be. Like, if you're looking just on the calendar for something that could encompass the where we are in this market. Nvidia is the general.
Okay.
And like we could take a look here. Let's just have a peek at Nvidia. But this was I don't know whether you want to call it a prairie dog, but it has prairie dog characteristics.
Oh, I agree.
Which is that, after an extended consolidation, it tried to break out and immediately gave the entire breakout back.
Yep.
Now, has it officially started a sequence of lower highs and lower lows? No. But we're in a situation where this thing hit a $5 trillion market cap, and the AI bubble has been the sole driver of it. And there's only one stock that truly encompasses the AI bubble, and that's Nvidia. And so the question becomes not whether they beat, because I will bet money that they will beat earnings, just because the hurdle itself is always set at a place where the company can beat it.
100%.
And so
if they don't, Patrick, there's going to be a disaster.
It's going to be a disaster.
Like,
but let's assume they're going to beat, because I think that is a very fair assumption. But the expectations for AI have been set so high.
Yeah.
The question becomes, is it going to be enough, especially on the guidance, or will it trigger those people that feel the urge to sell the news?
Yeah.
Irrespective of the beat.
And I think the guidance is going to actually matter the most. That's what's going to mean everything. It's not the actual earnings. Mm-hmm. You're absolutely correct. If it doesn't beat, it'll be shocking, and it'll be literally catastrophic if they don't beat. They're going to beat, but it could still be bad even with a beat, depending on how they guide and where we go from there.
Exactly. And so we have a scenario here where if whatever reaction to their earnings comes out, and Nvidia is below that 50-day moving average within days of its earnings, we've got a crack that could steamroll the whole market.
Okay, can I suggest something that often occurs in these sorts of situations? You get a beat, they guide, it seems positive, you get a gap higher, and that gap higher gets sold.
Absolutely.
Look at Oracle. They beat, they raise, there's all this crap, and it's being sold ever since.
And been sold ever since. The other example, which even though it may not be a perfect example, because Microsoft gapped before its earnings,
there we go.
Microsoft basically rallied for a double top retest, and then on its earnings beat, and it's been selling ever since, including now trading below its 50-day moving average for 2 weeks. Right. And so this is definitely what investors have to watch for if that happens in the post Nvidia earnings. Now, could it be a scenario where, the incredibly high vol premiums? Let me actually observe on my side screen here where we're already trading on Nvidia's earnings. Sorry, on its vol structure. Hold on.
Well, here I can also tell you what Bloomberg has got for an expected move.
So here, right now, it's at 67% on the Novembers, but let me put the November. So right now, 67% implied on the November 21st expiry.
So they have a 6.3% implied move on earnings, which is shocking considering it's the world's biggest company.
Yeah.
Right? Like, that's pretty large.
It is. It is a large implied move, and so we're gonna find out for sure, whether or not this becomes a trigger point or not. I would, if I still, my spidey senses are here that the market still bounces here the days before, at least Nvidia bounces the days before its earnings. I can't imagine, Nvidia trading at a 1 week low going into the earnings. I feel that there's going to be enough people that are going to want to speculate where at least it's going to stabilize.
Yeah. And I
And
think your call about the OPEX is also interesting and seems well thought out in terms of that potentially could be the moment that the bull gives it up and rolls over from there.
right. And these are all the kind of things that can play out. So here, with the fact that the bulls saved the market again today, really does put the OPEX and that Nvidia earnings as the kind of center point, which I still think that after all the dust settles afterwards, that last week in November is a highly vulnerable moment for things to really be moving underway. And like when I often love to look at the markets from a pain trade perspective. I always like to make a base case is what could screw over the maximum amount of investors, and use that as a starting base case. And investors kind of being punched into the Nvidia with a little bit of a gap higher on its earnings, like everything is going to be good. Everything kind of all those people that have those November hedges on their books, they're all going to roll off. And suddenly, with the implied vols right now, like the VIX had another jump to 22 today. Where is it now settling in? Hold on. Right now we're at 20 on the VIX, but we're now at a situation where hedging is no longer structurally cheap. I mean, it's not super expensive. Like we're not paying 30 plus on implieds, but it's going to make a lot of people question whether they should spend the money on hedges when they have to pay up for them.
Yeah, not only that, Patrick, hedging has cost money this whole period. The volatility risk premium, which is the difference between the implied and the realized, has been record high for a while now. Not record high, sorry, consistently high, meaning that versus realized, it's actually been expensive to hedge. Yeah. One of the things that I think that has happened is that a lot of folks have looked at that and said, okay, it's expensive to hedge in the stock market. I have just lost money on this. And if you actually look at gold, gold has been a better hedge in terms of protecting my portfolio. So I think that we've seen an increased use of gold as a hedge for the portfolios.
I think that's such a stupid idea. I think I think it's not going to work.
So I agree, but if you look at Patrick, the thing is,
I'm not saying people haven't been doing it. I'm just saying that I think that's a really bad hedge.
No, and I understand in a deflationary kind of risk off moment, gold will also get sold, and it is. But in terms of the numbers over the last year, you've been better off owning gold as a hedge than
certainly it carried better.
Right. And I think that's what's happened is that a lot of folks have just looked at the numbers and realized, because not only is it carried better, Patrick, but it's also worked in terms of on days when the stock market went down, it was a positive risk, like an up move in gold. It was negatively correlated to on down days, it was negatively correlated to the stock market.
Well, today when the market was down below the 50-day moving average, gold was down 150 bucks.
No, and I think that this is the problem, is that a lot of people do have that on now, and that there is a lot of, stranger things happening. And the other thing that I was, you go back to your point about the fact that the market always hurts what what consensus is, whatever. It tries to make a fool of the greatest amount of people. I can't remember which one of the 1920s traders said that, but if we look at what is consensus right now, I don't know anyone. Well, I shouldn't say that. Very few people think that we're not going to rally into year end, meaning that the consensus is we're going to rally to year end. That is how everyone is positioned. Yeah. And I worry because, they talk about seasonalities, and that was what I was going to kind of highlight when you're saying that we go down after OPEX. But if you go look, everyone's passing around charts showing the seasonality and how we're approaching the most bullish time for stocks. And one of the things that I just would like to highlight here is that the seasonality didn't work in September this year.
There's a lot of times.
But right. Like I almost think the seasonality, the fact that we're all looking at it so much, has made it a self-fulfilling negative, prophecy. meaning
Yeah.
that everyone is positioned for that. So therefore it doesn't work because everyone's watching for it.
You know what? You know what? I feel a very good exercise might be, Kev, to take the seasonality data and analyze it in the context of what the market did in the 6 months prior, and
But a lot
use
of
that
guys
as a benchmark.
do that. A lot of guys
Because
do that. I've seen it and it's still bullish. There's no doubt about it. But having said that, it was supposed to be bearish like in September and it didn't work.
like
And I
for
just,
me, I'll give you an example here. So
okay.
going back to this sell-off here that happened in 2023, right? It started in the summer. The traditional September October period was weak. You know, the market from peak to trough had a 11% correction on the downside. When a market is oversold, I love to use a bungee cord example, no different than Liberation Day, is that when the bungee cord is stretched to the downside, the snapback has more velocity. And so the fact that the stock market had a seasonal Christmas rally into year end that was a 17% run on the upside made a lot of sense, because the market started from a depressed level,
Yeah.
oversold. Corrections already been washed out. Systematic traders were already
Yeah.
repositioned, and there was an opportunity for a year-end rally. We're
So
in the
both
exact
seasonals
opposite.
both seasonals fed on themselves and created the pot
Yeah,
the inline seasonal moves. And you're arguing almost now it's the opposite. We're seeing a situation where the September seasonal didn't work, whereas aren't oversold into September. And in fact, we just rallied into it. And now
exactly.
going
The
into
sell in May and
yep.
go away. We saw the S&P 500 from May till October basically have like a 30% freaking rise.
Yeah.
So like the market is starting at the highs of a thing. The seasonally weak period wasn't there. So why would one expect that suddenly this time around the seasonality is going to work? You know,
Because Patrick, they all want it to work because that
yeah,
is the consensus opinion.
the
So that's
perfect
what you
example,
yeah.
the perfect example of what I think is vulnerable, even though I don't think the same percentage has to play out. But notice here, from May till September of 2018, we had a market rally. Now, here's the key. Trump was in office during this time. So all of these guys that are all say, "Oh, Trump won't let the market crash,"
Oh yeah.
shit. That garbage that you hear out there, like somehow he has this magic thing that he can prevent the market crashes. Well, people have to remember that the Volmageddon happened under Trump, and so did the Christmas massacre happen after while Trump was in office. So saying that somehow Trump can find a way to make these things not happen, it's just like such a ridiculous statement. But point being is that you had a seasonal period where the sell in May and go away was the opposite. We had a stock market that ripped higher during that period, and once October rolled around, we went through a Christmas massacre
Yeah.
where the stock market sold off in that window of time, which seasonality said was supposed to be rallying.
Yeah.
And I think basically seasonality is a nice rule of thumb, but you need to assess the conditions of the market at the time, and not somehow magically say that, well, seasonality has always worked in the past and therefore it's going to work this time.
Yeah.
I think it's a horrible way to anchor yourself in the
I
in
like
this.
it. Patrick is spicy about the seasonality. I like it.
Look, it's not that I'm not going to dispute the past. All
Yeah.
I'm saying is that after this market had the largest rally without a 5% correction and the longest rally without a 5% correction in history, betting that, oh, well, we can just exclude all that and just say that the market's going to keep going because seasonality says so, is, I
Yeah.
think, dangerous assumption to make
I like it.
on that front. Okay, so obviously we're talking a lot of these equities. Another thing I wanted to just highlight before we go on, because I want to talk other parts of the markets. I want to highlight that we're starting to see the cracks on small caps. Small caps have successfully also stayed above their 50-day moving averages since the May low. There was one little brief scare in July for a day, but overall the trend was there. We yesterday had the first legitimate close below the 50-day moving average, and we didn't rebound today above it. So the small caps have actually broken. And not only that, they've broken to lower lows. Like these necklines have already given out. And so we're already seeing deterioration in some of these spaces. Now, another interesting thing is the equal weight S&P 500 looks a lot like the financials index, which is that we've already been on the equal weight index going through what I would consider a distribution cycle for 4 months, which is the bull market. So at big picture, we divide the markets into 4 segments, and there's not just bull and bear, but there's accumulation cycles and distribution cycles. And the characteristic of distribution cycles, Kev, is that the market holds near its highs. So people keep seeing the returns on their market value, like the bull markets made them all this money. But the market stopped going up, where basically you've reached a fair value zone where there's ample supply of market up there that prevents the stock market from actually rising any further. And almost all buying is met with selling, but all selling is bought on dip, and it creates what technical analysts call topping formations. Like they become periods where the market is heavy. Well, we've basically been in this kind of a distribution cycle since July in the S&P equal weight, just the way we have in the financials. So right now, when analyzing the S&P or the Mag 7s, you're analyzing Nvidia. You're analyzing the AI bubble. But when you then take the rest of the stock market, it's telling a very different story. And the best way that I can describe that is think back to 1999 and 2000, where the dot-com stocks ran the NASDAQ into this parabolic rise on the upside, giving a historic run, while the S&P 500 spent almost a year with no real progress higher. It literally stayed flat while the NASDAQ ran. And you almost now, because Nvidia and these stocks are such huge components of the S&P, now the only way to really get that same kind of comparison is looking at the equal weight S&P versus that of the S&P or the NASDAQ, because it's giving a broader picture. And so you can see a very, very heavy equal weight index, yet that has not broken down yet, but certainly has lost all mojo, no momentum, no real progress. It's been stalled out here. And that, to me, is just continuing to support this idea that a correction is imminent.
Isn't that an Austin Powers premise of a movie? That he lost his mojo?
Yes, I happen to steal that right now.
All right. Is there anything else you want to talk about, or you want to just leave it as a stock only? Because I feel like it's...
We got to move on.
Okay.
We've got to move on.
Okay.
All right. We got to talk about gold. Oh, first of all, let's just the dollar. By the way, I think the dollar's a big buy on dip here. Coming back to the 50-day moving average, coming right to the fib zones. And that actually may be also something that happens in a risk-off cycle. In fact, with the very low implieds on currencies, maybe on a cost-adjusted basis, going long US dollar calls may be an actual very interesting hedge to put onto your portfolio, because it's very likely that a US dollar rally may happen during a risk-off cycle, and very, very cheap implieds, making it have the potential to give you a real kicker if that correlation happened.
It's funny you say that, Patrick, because this week I looked at my portfolio and I looked at the different positions I had, and I wanted to, as the stock market came down, I wanted to do something in terms of, starting to work and things like that. And I was thinking about different things I could do. And then I realized that Charlie McGilligan has been talking about all these TY vol buyers, like the fixed income vol buyer. And I was looking at it, I was like, oh, no wonder they're buying this. It's super cheap. Like the move has come way down. I went and looked at these positions, And it wasn't really, they were just vol bets as opposed to direction bets. And I realized that one of the issues is that the government's been closed. There's been no information. So even though you would think logically market still moves around, it hasn't. Because it doesn't know how to deal with the lack of information. So now that the government's reopening, I think what you're seeing is an increase in people that are willing to now all of a sudden buy vol again because they think there's going to be some releases. So vol is being bid in the fixed income square. I think it's also being bid in the stock market square. And I think that was yesterday. Part of the problem Thursday was there's just a relentless bid in the VIX. And that caused a lot of selling and it kind of fed upon itself. But though this is a long-winded way of saying, Patrick, I also bought some foreign exchange vol. And I didn't even say, for the first time ever, I usually have a view in terms of like, I'm going to, be bullish on the US dollar, bearish on whatever. And I've gone and instead of actually betting on a direction, I've just bet on vol.
Straddled.
I said, yeah,
straddled it. Strangled or
straddles. Yeah. I'm just going to get long vol because I think that you're spot on correct. This is too cheap. I still contend it's been one of my worst calls in terms of expecting there to be some FX fireworks, and there have not been any. And I haven't talked about it in a while, but it was just this kind of hit a point where I was like, oh, it's time to buy them again. So I went out and bought some, tried to pick away at some 1 year stuff. I think that it's cheap. I also bought some fixed income vol. You'd be proud of me. I'm trading that. I think that there's this whale out there that's doing this big buy of volatility out in the actual T-bond pit. And I kind of just tagged along with them. I'm saying like, yeah, this is cheap. And I look into the last couple months of the year here. I think a lot could happen. We got the government reopening. We got economic stuff. We have the Trump, we won't get into it, but there's a lot of political issues in terms of things like that.
Yeah. So the interesting thing that I saw from, I'm trying to remember which analyst was a report I saw it on, but the interesting thing that he made the comment was that, is it possible that everyone's waiting for a bear market, a recession to inevitably trigger a bear market? But what if it's the opposite, that a bear market triggers a recession?
Oh, Cuppy's been saying that forever. That's his line. He says in the old days, recessions cause stocks to go down. These days, stocks going down cause recessions.
Right. And so the question becomes, if we end up having some sort of AI bubble burst, which is, by the way, not something I want to think. While I believe the stock market corrects, I think the AI bubble bursting is going to be a 2026 story, that it's going to take months for us to really know for sure that that's materializing. And I don't want to stick my neck on the chopping block making that call. But if the AI bubble burst and it rolled, which means that the S&P would not make a higher high going into after some correction, then that could lead to a recession, because the stock market will get hammered again, and panic will kick in. And that could be that trigger point that creates it. And no matter how many people out there say, well, Trump won't allow this to happen, well, there's only so much his tweets are going to be able to do. Let's
well, not only that, they all think, oh, he's going to do stimulus checks. Eventually, the fiscal room runs out. Like we're seeing that in the UK. They try to stimulate, and the bond market revolts.
Yeah.
And so we see that. And eventually there will be no fiscal room in the US. I don't know when that is, but there will hit a point where there'll be less fiscal room, and they won't be able to do it in the bond. The stock market will actually react negatively. At which point people will say, it's okay, he'll do yield curve control. And you go, okay, fine. He does the yield curve control. Guess what happens to the dollar at that point? Yeah. There are limits to this. Isn't it ironic, Patrick, that like all the guys that kind of shit against the MMT and were so negative about the idea about there was no real resource constraint and it was always a financial constraint, and now they've all of a sudden become, there's just no restraints, period, that they got, that everyone seems to have forgotten that there are limits. And I 100% believe that there are limits, but we've somehow been lulled into this belief that that there's no limits and that Trump can just keep printing and printing and printing. So yes, at an extreme, he could cause the stock market to stay bid because he could just, inflate his way out of it. 100%. There's no doubt about it. But that's, I just want to make this clear.
Yeah.
Eventually that ends up being a nominal game as opposed to a real return game.
Yeah.
And the reality is that there are limits on a real return basis if he can protect the stock market.
Right. And I want to just also highlight one quick thing. A lot of people talk about the midterms and that they won't allow the stock market to go down into midterms. Correct me if I'm wrong, but the Christmas massacre was actually well underway during the midterms of Trump's last administration in that the end of 2018. And so this idea that there isn't or can't be some sort of a market event occurring into midterms, well, there are clear evidence in previous market cycles, including one where Trump was president, where this happened. And
you're a silly boy, though. You don't understand how much smarter Trump has gotten, Patrick.
Well,
that's your problem.
And more powerful. He's definitely more powerful now.
That's your problem.
So the next thing I want to talk about is also a risk asset problem is the fact that crypto is selling. That is your kind of quintessential risk asset, and lower highs, lower lows, already a double top, broken the necklines, in full sell mode. I'm not trying to make bold calls about where Bitcoin is going, but rather that a risk asset distributing this way is a sign of liquidity flows, and the fact that it's selling, I think, is also a further evidence that the market remains vulnerable.
Got it.
The next thing gold.
Sorry. Gold. Okay.
So I made a call when that high came in that that was going to be the high of the year, and a lot of anxiety for me when the last little rip happened over the last couple of days, like if gold was going to resume in a big way. But I wanted to stress the importance of the 4,200 level on the gold price, because often corrections happen in two waves. What I often use this drawing tool to simplify that, and there from a very oversold state, gold bouncing was the expected thing. We in fact published trades going long silver and doing a bunch of other trades on short-term trades, expecting this kind of a bounce. But this 4,200 level is right where the fib retracement is, which is the typical kind of highly vulnerable area for where these point Bs on corrections happen. The fact that we reversed $100+ on gold off of that high point leaves very much on the table that there could still be one more leg down. Now, overall, I remain big picture bullish gold. I think gold will be a 5,000 plus a year from now and so on. What we're just talking about is the fact market corrections happen, and gold is not some magic asset that gets to avoid having corrections. Gold is just another asset, and it trades like every other asset out there. And we went through a bull run. Now, it's important to highlight that the previous 4 corrections on gold lasted anywhere from 2 months to 4 months before gold was able to break to a fresh new 52-week high. And so with this only being 30 days into this correction, this would be the shortest corrective sequence we would have had of this being the 5th correction of the last 4 I'm referring to, where after such a big run, if this thing already a month in was already breaking to 52-week highs, it would be the shortest correction in all of them before a new high is printed. And so I still am in the camp that the vulnerability is that gold chops through the rest of the year. whether that ends up being a big horizontal triangle formation or whether that ends up being a correction that still prints 3,800 or 3,700, I still think gold is in a corrective mode. It will lead to the next bull market in gold. I'm not trying to be bearish, other than that I don't feel that this is that holy shit, if you didn't buy, you missed it. And you got to buy everything and anything. I think there's still time to position into gold throughout the next month or so. I think there was going to be a lot of fake out rallies, a lot of sideways consolidations. And if there is going to be a fresh breakout, it's going to be a 2026 story, is my kind of sequencing in terms of timing on the upside. Interesting that silver did a direct retest. Will that in the end be a double top? It's so premature to draw that conclusion, but it did stall at its previous high, which is usually a key resistance level. The sell-off that we saw in the last 2 days is coming already. I'm going to put this quickly on a 4-hour chart and highlight that it slammed straight into the Fibonacci zone. I mean, if we see silver in any way sustained below $50, it increases the likelihood that it was a double top, and that silver is going to still be correcting for a little bit. If the bulls are going to save this thing and keep silver running, it's going to stay above 50 the whole time. And that's the easiest way for, I think, all our listeners to look at it. Silver stays bullish so long as it's staying in the 50 handle or higher. And if we have anything start breaking below 50, then the risk of a double top and a deeper correction becomes much higher probabilities.
Got it.
All right. Next thing. I still don't think oil breaks to a lower low. And you know what? We had a big sell day. Everyone was reaching for excuses as to why that sell-off happened the other day. Trump promised certain gas prices. What other headline was there that you saw?
I don't know. There was a million.
There was a million garbage ones. There was not one legitimately good one.
Spoken by the bull.
But no, but I like legitimate things. What happens is that everyone loves to have a reason for everything. The idea you say, well, there were just more sellers than there were buyers, seems completely unacceptable to anyone to say. There has to be a reason for everything.
Oh, and you know what? I'll tell you, as a guy who sat on a desk and had orders that moved markets, it's way more random and arbitrary over the short run than anyone imagines.
Exactly.
Like they just do. Like I remember sitting there and waiting because, one of my big clients was going to get long Canada, like was going to increase their equity exposure. And I remember talking to the trader going like, is the order coming? And he goes, oh no, somebody's sick. We're going to have to wait a week. Okay. So they waited a week to do it because they had to go through the investment committee or whatever. Right. So then the next week comes and he gives me this order and it's like monstrous. And we're like buying the Canadian market for like a week and we're just constantly on the bid. Right. And so we're sending it up and I'm watching TV and I'm watching them talk about why it's going up. And they're coming up with like the news of this, blah, 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 blah. And I was like, that's bullshit. I just bought this thing. I knew why it was going up. I knew that it could have just as easily been the previous week. And then, other times I've seen, a portfolio manager fall in love, like Fidelity gets in there and they fall in love with the stock. And the reality is that they'll buy that stock for a month and it'll be going up day after day after day.
They're taking the positions.
Yeah. And so people read everything into like the one specific day. And I'm like, it's just BS. Like it's BS. Way more random than people think over the short run. Over the long run, it all gets sorted out and it is going to go where it's going to go. But to explain the short-term movements so precise, I just laugh whenever I hear someone saying it.
It's silly. So point being here, what I find interesting is yesterday, we dipped straight into a fib retracement, like right into the 61.8 with that red candle, and we reversed, and we're almost completely reversed the entire breakdown candle in 2 days. And so dips are being bought. Now, are we above the 50-day? Have we broken this descending trend line? We actually still are in bear mode in the sense that there is absolutely nothing bullish yet that has happened.
Right.
But I also think that this has all of the characteristics of a bottoming formation, and I still think there's plenty of room. And like one of the big things, like it's like I'm shocked that no one sees. It's like one of those things I think will be that nobody cares until everyone cares all at once.
Yeah. Yeah.
I think the Venezuela buildup is very much that. Like there's this buildup and no one seems to care. And I've heard even some crazy argument made by someone that that it's actually bearish for oil if they attack Venezuela, because that means that they're going to bring all of that oil onto the market
Eventually,
or something.
long run,
Eventually,
long term.
long run. But they're trying to make an argument that this is not going to impact the oil market.
Who is that idiot? Who's that idiot that's
I'm
saying
not
something
gonna,
like
I'm
that?
not gonna, I'm not gonna say his name out loud. But
That's
I
very
will.
kind of you to not make a fool of that guy.
Yeah, but the point being here that I still think it's one of those things that when it becomes a reality, and you don't see this kind of a buildup. Some people were saying online that this is the largest military buildup since Iraq by the U.S. in one area, and the idea that they're moving this many resources and are going to do nothing is, to me, unlikely.
I just think there's better reasons.
What is it going to be?
There's better reasons to be long oil than them moving some ships across into Venezuela, close to Venezuela. And listen, maybe you're right. I don't know. I'm just
talking about what could shift sentiment. What could shift sentiment, though? And this is the thing. There's a lot. You're giving me a lot of fundamental reasons why oil will inevitably turn, and I agree with them. But what I'm curious about. And I'm just curious. I'm not even know if I want to make the bull call, but I think that oil will react to it.
I don't know. We'll see. Well, we'll see. You seem pretty sure that it's going to happen, and you seem pretty sure that oil is going to react.
I personally,
so are you saying more than two? One second. Are you saying more than like $2, $3?
Yes.
Or you're talking like 10, 20?
To be honest, to me, I would think that there's something wrong with the markets if we did not have a $2 to $3 reaction on a news headline.
No, but 2 or 3, we went down 2.
No,
so like I'm talking something real. Like, are you talking $6, 7, 8?
Well, think about it. We got a $10 move on them bombing the Iranian nuclear sites, which was arguably a highly fragile moment, because if it escalated into a genuine hot war of some sort, and a disruption of the canal, there could have been real problems.
Yes, so I would be much more willing to say that was a lot riskier than Venezuela. Like, that really mattered.
I just feel that the sentiment is so bearish right now on oil that it just needs a spark. It just needs something to light a fire, and the CTAs flipping and people feeling like they need to have skin in the game. Suddenly, people will not be able to get filled, and they're chasing, and a short squeeze is underway. Like that when you got this kind of environment, I think the asymmetry is massively skewed to the upside, in terms of where's the next $5 to $10 move. I think it's to the upside, not downside. I mean, look, we can't rule out that this thing trades to $55 and double bottoms its October low. It's not impossible, but if I was to say where's the next real legitimate move, it's got to be to the upside, in my opinion.
Okay.
What else you got?
What else you got?
Look, the only thing that I wanted to highlight on uranium, okay, so let's talk about the uranium stocks for a moment. They have started to break down, but what I find fascinating is the vol structure in the uranium stocks. They have, like, during that rally, vol stayed relatively calm. I'm just pulling it up here, but what we have seen is the implies have virtually doubled in the last kind of 3 months. We went from being down in the low 30s to up in the 60+% range of implied volatilities on not only Cameco, but all these uranium names all together. Now, the volatility on the way up was as volatile on the way down, but it's crazy, like a 60% handle on these stocks. Like, to me, it's making it very difficult to put on any options trade in the uranium markets. Like literally, going long gamma is making the risk reward payoff ridiculously awful, and it's just one of these scenarios where, like, uranium here, like, I would not be shocked if we were either down at $35 on this or up at 55, 60 in a month or two. I think these implieds are showing just how volatile the situation is here on these stocks. The question I have for you, are you in the camp that these uranium stocks were all basketed in the AI story, and that if the AI market turns, that it will change the liquidity flows on uranium story?
So I do agree with that, but I don't think that's why vol is bid.
Well, no, it's not why
So,
vol is
no.
big.
But
That's
and
not,
I
no, I'm
think
just
and I
talking
think the
about.
market is actually correctly priced that really high. Uranium is an important commodity for this administration, and I would say that the chances of something happening there are higher than not higher than the market expects, because the market expects a lot, but higher. The option market is correctly anticipating an increased chance that something occurs that's outside the realm of traditional finance, is what I would say there.
Bottom line,
They're
insane vol. Insane vol.
I think that here's how I would put this. They're anticipating a political move. And I think that they're correct in having those sorts of vols.
All right.
And I think it's interesting you bring that up, because I hadn't looked at the volatility, but that makes complete sense to me. I will say this.
I'm
Patrick,
not sure. I'm not saying it's stupid. It's just stupid for trading it. Like, the problem is, for me, with such high vol, I'm finding it very challenging to construct like any good payoff profile on trades. It literally, I mean, all you have is spreads. Like, you can go with like some quick little spread trades to try to dampen the vol impact, but beyond that, it's so hard to put on any uranium trade here.
Yeah, completely agree. But the market might be that
price,
rich for a reason.
Yes.
Okay, what else you
It
got?
might be right price. The last thing, well, this is it. Last thing, I wanted to just touch on the Kospi. And so one of the interesting things, and I'm shocked that I didn't bother to talk about this on the show for until now, but the Kospi has been the hottest market.
Why don't you tell people what the Kospi is? For
It's
those
the South Korean index, right?
Yeah.
And Samsung, and what's the other big? There's
Hynix or something.
Hynix, exactly.
I got that right?
Some Hynix name, whatever it was. The two major plays that are associated with the AI story, and so this has become. Those stocks have become the Nortels of the Canadian market, in a sense. Not that I'm predicting that they're going to blow up like Nortel, but rather their weighting in the South Korean index has become so big that they are the South Korean index, right? Like, they've literally just become the entire performance. And so as Samsung went 100%, so did the Kospi. Like, I mean, we had a trough to peak rally of 85% in this index. It blew the NASDAQ out of the water.
Yep.
This is incredibly narrow in that, even at least with the Mag 7s, you're actually more diversified in their businesses than you are in the two stocks inside the Kospi. And to me, I feel that this is the other canary in the coal mine. When the Kospi is officially peaked out and reversed, I think will be a very good sign that the AI bubble has burst.
Okay. I get it. Yeah.
like and it's an interesting one because for those relative those traders that do the relative trades like long short combinations, the fact that the Kospi went from 20 vol, this is a country's index, went from 20 vol to 40 vol
Yeah,
to 40 vol
because of the right tail, not because of the
No,
left tail.
but it did because
Yeah.
of the right tail.
Yeah.
But the vol is double that of the QQQ.
Yeah.
That to me is a disparity.
So
Like,
I don't pay for the Kospi index data, so I don't know what the weighting is, but I did pull up the EWY, which is the
Yeah.
iShares MSCI South Korea index.
Yeah.
And I'm looking at Samsung is 23% and SK Hynix, that's the name of it, is 18%. So what do we got there? 41%? Like
40, that's literally Nortel BCE.
yeah, but
Like,
it's also though the top 10 names in the S&P 500, top 10 is the same. So they've got two stocks that are the same weighting as the top 10 in
This
the
to
US.
me is the most ridiculous thing. Like literally you and so with the implieds doubling, I honestly think that you could play a relative trade, do a long QQQ against a short Kospi trade here. And I think that you're gonna on the upside at this point from this level, the QQQ would outperform, I think, the Kospi. And at the same time, if it turned, I think the Kospi will drop faster and deeper than the Nasdaq will. It's an interesting idea for a long short pairing.
Spicy, I like it. Okay,
all right, that's
you
all I
heard
got.
it.
That's all I got.
Okay, that's great stuff, Patrick. Okay, thank you everyone for tuning in. It was great to get this masterclass from our buddy Patrick Serezna. Why don't you tell us where they can learn more about these sorts of great ideas?
The shameless plug. You can find me at Big Picture Trading, but at bigpicturetrading.com. But you can also follow a lot of my video updates on my YouTube channel, Patrick_Serezna. So I'm putting out more content out there. So you don't have to wait every 2 weeks to get this update here. I bring all sorts of insights throughout the week, each week.
There you go. Patrick_Serezna. Wait, CERESNA.
Thank you. Oh my God.
On the YouTube.
All right. So, Kev,
and you can go to macrotours.com and listen, bear market, bull market. We're just happy to spend some time together on this great, fabulous ride. Now stick around for the after show. Okay, pumpkin beer. What do we got?
Oh my God. This is so, I only drank 1/4 of it and I'm not going to drink the rest. No matter how bad of a rating I've given.
Yep.
This is one of the first times I've not actually finished the
That's
beer.
true. That is really for you. That is condemnation, the worst.
2.1.
2.1. Well, at least it wasn't an amateur score like Daniel.
Yeah, absolutely. No, you know what? I am never gonna ever consider buying this beer ever again.
Are you one of these guys who likes the pumpkin spice? Because I can't stand it. I think it's awful. I don't like anything pumpkin. Like, do you like pumpkin pie?
I'm mid. And in other words, like that's a term my children taught me.
Yeah.
It's a Gen Z talk. But but I'm not a hater of pumpkin, but it's not like something I'm looking for. Oh, it's a pumpkin season.
Yeah.
Like, like I'm not. If it's there, I'm more than willing to
eat it.
But yeah, it's
I'm not a fan. I'll take an apple pie any day or some chocolate.
Absolutely. So, Bud, I was in Toronto last week. We didn't.
Why didn't you call me?
We didn't meet up, but of course, I come to Toronto and it freaking snows.
Yeah, well, it's your fault.
It is my fault.
You brought it. Like they were like
literally 6 inches of snow in early November. Like the idea of Toronto even having snow at Christmas is sometimes something people dream about. And here in November, that lays down like.
You know what was interesting? It also stayed for a little while, which was very unusual. Like that, usually you kind of get like the one day and then the next day it goes to 10 degrees and it all melts. This one, it stayed cold and it stayed on the ground.
Yeah.
Well, anyways, it's your fault. I blame you. And also, this not phoning me up. This is bullshit.
Dude, I had a packed schedule. I flew in for a wedding, and
I understand. Oh, okay.
you know, like I had some other stuff. If I had free time, I'd love to. But
okay.
when I come back, you know, and I was thinking about coming back into winter, but I remember being snowed in and my flights being canceled for 48 hours in February. So I might wait till the spring to show up my face in Toronto.
Well, listen, over winter, I'm thinking about maybe going somewhere in Europe for a little bit. So if we do that, if I end up somewhere,
come to my place in Italy. We're going to be just some skiing up and down.
Okay, well, anyways, if we do that, we should figure out a market huddle meetup somewhere fun in Europe. We should do one wherever. We'll try to figure something out.
Done.
You know, and we'll go and get all those Europeans, and we'll drink some beers. You know, they can teach us what real beer is like.
All right.
Anyway,
well, let's wrap things up. Thanks everyone for tuning in.
Thanks. Take care.